anything as related to major long sums as such for the internals only. Okay, so will we do your
Ma'am, can you repeat Unit 5?
unit 5? I have given one simple problem. There is one theory question, and because there are sections, right? So in in section A, there's only theory for your very short answer question, 1 marks. Only I have given is theory for all chapters. Section B, which is short answer questions, there I have given theory as well as a simple straightforward sum. All right. So we do such short answer problems so that section B you can solve problems. Section C, if I've given something like to draw the format of the liquidator statement of account. So thereby just by learning the format or the theory questions, you should be able to do section C. Simple as that. Okay. So what I'll do is amalgamation. I will do one problem, small problem, so that you should be able to solve the internal question. Internal reconstruction will do good two problems because I have given both. There is no theory in this chapter, and that's an easy chapter, so we'll concentrate on unit 4 so that we can do as much as possible on that and score marks in unit 4. Unit 5, what is required, that much only I will teach you as of now. Then in class, we will do after your internals more on problems on unit 5 and then come back to unit 3, that is amalgamation. That clear? Does that sound fine for you all?
Yes,
Right
yes, ma'am.
now, only for
Yes,
your
ma'am.
internal 2, what I'll do is your amalgamation. I'll just quickly explain what is amalgamation. Right, that is your unit 3. Can you see the screen, everyone? Is it
Yes,
visible?
ma'am.
Right.
Yes, ma'am.
So we have amalgamation, as we all know, it is nothing but wherein two or more companies they merge together. It is called as amalgamation. In simple terms, it is merger or absorption, right? We use the term companies have merged or one company has been absorbed by another one as very interchangeably. So basically what is amalgamation is, it is when two or more companies are combined together. That's the reason why that's also called as business combinations, right? So when two or more companies are combined together into one, either by merger or by taking over, that is either by merger or by purchase, then it is called as an amalgamation. So meaning itself says there are two types of amalgamation. One is amalgamation in the nature of merger, wherein two or more companies are merging together. They are combining their assets and their liabilities. They are bringing together their capital and they are forming into one big company. That is called as merger, wherein earlier old companies will lose their existence and a new company will be formed, which is a much bigger one. So there's a formation of a new company when it is a merger. But if it is a takeover or a purchase, that is amalgamation in the nature of purchase is the second one, wherein in case of purchase, as the name itself says, one company is taking over the other, one company is acquiring the other, one company is purchasing the other one. So the old company are two, but the new company is only one, wherein this company completely takes over the other one, and in future you will have only this company which has actually taken over. So if I give you this example of A and B, two or more companies joined together to form a new company is your merger, whereas absorption or purchase is wherein blending of one company by the other, wherein one company A limited blends into or joins B limited as such. So it is called as absorption or amalgamation in the nature of purchase, right? So B Limited has taken over A Limited and A Limited does not exist. Which company is existing now? It is B Limited. But in the previous case, we have A and B both have come together. They have both joined together to form a new company which is C Limited. A and B both lose its existence and the new company C will only remain. Right? So here we have an amalgamation, whatever be the type, you will have two companies. One is the transferor company, the other one is the transferee company. Who's a transferor? The company which is selling its business, right? So if I told you in the merger, there were two companies which were selling A and B. They sold their business to C company, and who has purchased? C company has purchased. So when it is a merger, you will have two transferor companies. A Limited and B Limited are selling off their business. And who is purchasing? The new company which is C Limited is purchasing. So A and B are called as transferor companies. C Limited is called as transferee company. In the second case, that is, in case of takeover or purchase, there's only one company which is selling. A Limited is selling its business, B Limited is purchasing A Limited. So A Limited is called as transferor company, B Limited is called as transferee company. Did you understand the types? Got the scenario, everyone?
Yes, ma'am.
Amalgamation when it is a purchase, merger, and amalgamation when it is a purchase. Got it?
Yes, ma'am.
Yes, sir.
Yeah. So now when it is a merger, how will you identify that it is a merger first of all? Because for our problems, we need to first identify, the first step is we need to find out what is the type of amalgamation. Is it a merger or is it a purchase? There are five very important points that have to be kept in mind, which will identify that it is a merger. If these points are satisfied, only then it is a merger. If these conditions are not fulfilled, if these conditions are not satisfied, then it will be called as a purchase. What are those conditions? All the first one, all the assets and liabilities of the transferor company. Who's the selling company? Who's selling the business? It's the transferor company, right? All the assets and liabilities of A Limited, they become the assets and liabilities of the transferee company, that is the purchasing company, which means the new company takes over all the assets and liabilities without any exception. The new company cannot say that I will not take over your stock, or I will not take over your buildings, or I will not take over the debtors. The loans, the creditors will not be taken over. No, there is no option as such. All the assets and liabilities have to be taken over by the other company. Then only it is called as a merger. Because when it is a merger, what is happening is both the companies are losing in existence. They cannot say that some of the assets will be taken over, some will not be for the new company. New company has to compulsorily take over all assets and liabilities at book values itself, which means no adjustments is intended in the book values. Whatever you see in the balance sheet of the transferor companies, at the book values itself, all the assets and liabilities have to be incorporated by the purchasing company. That's the second point. So, 2 points we have to remember: merger, all the assets have to be taken over, all the liabilities have to be taken over, no exception at all. And the second scenario is they have to be taken over at book values itself. So the moment you see in the sum, it says that any assets are not taken over, or the transferee company doesn't take over the loan or the debentures, or if he says it is taken over, assets are taken over at revalued values, new values, it has revalued it and taken over, then immediately you will say that this is not a merger but it is a purchase itself. Did you get it? The first two conditions. This is the major ones which will you will have to check in the sum. that all the assets have to be taken over. The moment he says any exception is there, it is not a merger. And if he says that they are taken over at new values, adjustments may, he gives any revalued values, immediately it means it is not a merger, but it is a purchase itself. Then third condition is that all the shareholders, that is 90% shareholders holding 90% of the face value of equity shares of the transferor companies, will become the equity shareholders of the new company, that is the purchasing company. So more than 90% of the shareholders agree that yes, we will go for merger. Then it is a merger. If 60% or 70% or 50% shareholders agree to it, then it is not a merger, but it will be considered as a purchase itself. Wherein only those shareholders who agree to joining the new company will join, and the others will withdraw their capital. So they have to be paid off their shares because they do not agree to the merger, to the takeover. So if 90% agree, then it is a merger. If not, no. Fourth condition, the purchase consideration is discharged by paying by the purchasing company itself wholly by issue of equity shares. So the new company, how does it pay purchase consideration? First of all, understand what is purchase consideration. When one company is purchasing the other company, it has to pay something in return. If I'm taking over your assets and liabilities, I have to pay you something for that, right? That something is called as purchase consideration. So the purchase consideration for amalgamation is discharged by the purchasing company. How will it pay the purchase consideration? Only by issue of equity shares. That is why all the old shareholders will become the shareholders of the new company itself, right? So by giving you the new equity shares, I'm giving you the amount of your value of your assets and liabilities, that is your purchase consideration, right? But if he says that the purchase consideration is paid off in cash, why is it paid off in cash? Because the shareholders did not want shares of the new company. That's why it had to be settled in cash, which means immediately that it is not a merger, but it is a purchase. Okay, and the last condition is the business. What happens to the business? When it is a merger, the business of the transferee company is intended to be carried on after the amalgamation by the transferee company. So after merger, C Limited will continue to do the business of A and B Limited together as a joint business, large scale business. From two small scale businesses to a large scale business, the business has to be carried on by the transferee company. It is intended to do. But after takeover, that is, if I purchase some other company, it is not mandatory for me. It is not compulsory in case of purchase that I will continue your business. I may continue, I may discontinue, and I can use your assets for my purpose itself, right? So your assets, your business assets will become my business assets, your capital will become my capital, but I may not continue your business. Your business will come to an end, and I will use those assets and that capital for my business itself, right? So these are the 5 points which identify whether it's a merger or whether it's a purchase. If all 5 are satisfied, it is a merger. If any one is not satisfied, then it is a purchase. This is important even for your theory question. Is it clear? 5 conditions.
Yes.
Yes, ma'am.
Then coming to what is the nature of purchase, I told you if any of them is not satisfied, it is a purchase. Now, when it comes to accounting, second, I'll just show you this. Let's first see the. This is also interest only. Ah, this is the journal entries that will happen. The accounting treatment will be journal entries in the books of transferor company, journal entries in the books of transferee company. right? Both will be asked to you in the examination. That is, you could be asked only transferor company because you have short answer questions, transferor company only, and transferee company separately. Right? So we'll first see what is the accounting treatment that will happen in the company which is selling its business. Remember, this company is closing down. This company is selling off its business. So what he has to do is it has to open an account which is called as the realization account, wherein the balance sheet as it is existing. You remember balance sheet, assets show debit balance, liabilities show credit balance, right? So whatever assets are there, they are all transferred to realization account. Whatever liabilities are there, they are all transferred to realization account. Now what we have to remember is assets show debit balance, and to cancel that debit we have to credit assets. So what are we doing? We are debiting realization account and we are transferring all the assets at book values itself. So the first journal entry for transferring assets to realization. So you'll be given a balance sheet in the problem. What you'll do, all the assets that are there, you will transfer it to realization. So the first entry you will write realization account debit to land and buildings, to plant and machinery, to debtors, to cash, to stock, all the assets. Remember, what is important is we will not transfer fictitious assets. We will not transfer fictitious assets because fictitious assets are not assets and they do not have any realizable value. All fictitious assets on account of when you sell your company, if you're having any fictitious assets, that is accumulated losses, your shareholders have to bear it. You cannot pass it on to other company. So we will not transfer fictitious assets. We will only transfer fixed assets and current assets. At what values? At what values did I tell you we will have to transfer? All assets and liabilities will be transferred at
Book
all assets and
values.
liabilities will be transferred at book values itself. Yes, everyone
Yes, ma'am.
following?
Yes, ma'am.
So if I prepare
Uh,
realization account, as you see in the balance sheet, you will transfer two sundry assets, all current assets and all fixed assets at book values itself. Next, come to the other side, that is your liabilities. All the liabilities, that is outsiders liabilities, that is your bank loan, debentures, sundry creditors, bank OD, all these will be transferred to realization. Remember, liabilities show credit balance, and to cancel that, we have to debit liabilities account. So liabilities account debit to realization is the journal entry. Then whatever is the purchase consideration which is receivable, it is an amount which is being to be paid by the a new company. The purchasing company has to pay us this money. So the entry will be purchasing company account debit to realization account, because you'll have to compare it in the realization account with your assets and liabilities. So I will compare how much I received by giving off my assets and liabilities. So the journal entry for purchase consideration to be recorded is realization account is credited. So come to the credit side and write it as by purchasing company account. That is by C Limited in this case. Next, we'll have to see, it will be given in the sum, how is the purchase consideration being received? Means how is the other company paying you? Is it paying you only in shares or is it paying you in cash as well? Whatever you receive, you will debit it. So debit what comes in. So cash account debit or bank account debit. Shares in purchasing company, that is shares in transferee company account debit to transferee company, because he's the giver now, he is paying us the money, right? That is the journal entry for purchase consideration received. After receiving the purchase consideration, if you have, like this will be only in case of purchase, that there will be some assets which will not be taken over by the other company. Those should not be transferred to realization account. There'll be liabilities which is not taken over by the transferee company. Those should not be transferred. That is why it is written here. See, only those which are taken over. Same way, only those assets which are taken over only should be transferred.
Last celebration report.
Then what about the others which are not taken over? You will have to sell them. So bank account debit to realization being assets not taken over realized. So you will have to sell those assets. Similarly, we will have to pay off liabilities which are not taken over. So when a liability is paid off, creditors account debit to cash or debentures account debit to cash or bank loan account debit to cash or bank with the amount which is paid off. If you're paying off the full amount, then no problem, just liability to cash. But if you're paying a less amount or a greater amount, then the amount less or greater should be written to realization account. So say for example, it is 10,000 rupees and you're paying off only 8,000 rupees. So the balance of 2,000 will be a discount which is written on realization account. The liability is for 10,000, but you're paying how much? Only 8,000. So 2,000 will be written to realization account. Reverse case. The liability is for 10,000, but you're paying 12,000 to them. That's why when your debentures are being redeemed at a premium, then you will write it as 2,000 extra on the debit side. Whatever is the difference in the liability book value and the paid off value will be written to realization account. That is what you need to remember. So when liabilities are transferred, check which assets are transferred, which liabilities are taken over. Only those transfer to the assets. And whatever assets are not taken over, bank account debit to realization account. And lastly, pay off liabilities which are not taken over. You will have it either at a higher price paid or at a lower price paid, at a discount or at a premium. That discount or premium also is written to realization account. To avoid all confusion, transfer all assets, transfer all liabilities. Then write the purchase consideration entries and then you realize it off as to realization account, bank account debit to realization. So don't get into the confusion of transferring some and not transferring. Transfer all assets and liabilities without anything. Only fictitious don't transfer. Then whatever is not taken over, sell it off as buy bank account on the credit side of realization account. Then for doing all this selling etc., there will be some expenses incurred. For all expenses on realization, the entry is bank account is credited, realization account is debited. So it will be realization account debit to bank account. Now in the examination, you could be asked journal entries in the books of transferor company. These are the journal entries. Or you could be asked just to prepare the realization account. So 3 marks question I have given preparation of realization account. So don't waste time in preparing the preparing the journal. You will just go with preparation of realization account. I'll show you where it is. A format of that was there somewhere. This one. I think this is also this is usually used for partnership. So it will be the same almost. ठीक है चलो. You'll see this. Yeah. Oh, not this, not this. Sorry. Where did that go? For company citizenship. We've done sums in the class, beta. Just take the notes from your friends. I have given this and we've done few sums on this. This is for your partnership only. coming as given for journal entries only, realization scenario. Leave it. You check the class notes, ma. It is there in the class notes. How to prepare realization account. Okay. Then next is we come to now the amalgamation in the nature of purchase. Right? Sorry. We didn't do transferee company. One second. In the books of transferee company, yeah, in the books of transferee company, as you can see, in the books of transferee company, merger is called as pooling of interest method. Right? So the transferee company calls it as not amalgamation in the nature of merger, but it calls it as pooling of interest method. This method is applicable only when it is amalgamation in the nature of merger itself. And we know what happens in case of merger, wherein two companies, their business gets stopped and they merge and form what is called as a new company itself. So in case of merger, what are the steps that have to be followed? See, the same points have been written here. In the books of transferee company, the assets and liabilities and reserves, that is all the reserves of the transferor company, should be recorded at their existing balance sheet values itself and in the same form as at the date of amalgamation. So don't make any changes, just write all the assets and liabilities and reserves at their balance sheet values itself. Right? If there is any profit and loss account of the transferor company, that is any accumulated reserves, etc., then it should all be added together. That is, the balance of profit and loss account of transfer company should be aggregated with the corresponding balance of transferee company, or it should be transferred to general reserve. So if there are any accumulated surplus, if there is any P&L balance given to you, you will add both of them together, or you can also add it to the general reserve of the new company. This reflects the fact that entries are simply merged and no goodwill account should be created. So you will just merge them, you will just keep on adding both of them and writing it to the new balance sheet. And whatever is the difference between these assets taken over and the purchase consideration which is paid will be written to what is called as the reserve itself. That is the general reserve only. So how do we go about? Firstly, in the books of transferee, the first entry is when he acquires the business, when he takes over the business and purchase consideration is due. Purchase consideration, I told you, is nothing but the amount which is paid by the transferee company, purchaser company, to the selling company, that is a transferor company. Whatever is the amount that is given, you will calculate it as purchase consideration amount, and the entry written is business purchase account debit to liquidator of transferor company account. Why? Because you are purchasing business and amount is payable to the transferee company, but there is no transferee company as such. It has gone into liquidation. So the amount is payable to whom? It is payable to the liquidator of the transferor company, right? So after paying the money, that is after saying that the purchase consideration is due, you will now take over the assets and liabilities. You will incorporate the assets and liabilities. So the assets and liabilities of the other company, the transferor company, are being taken over by the transferee company. So we will write the entry as sundry assets account debit, two liabilities, two P&L, two reserves, that is everything, debit assets, credit liabilities and reserves, and whatever is the difference between these two will be compared with business purchased account, right? So you will write assets, total assets book value, liabilities, all the liabilities and the reserves and the accumulated profits, and you will write to business purchased. this will not tally. The debit will not be equal to the credit. So what is to be done? Whatever is the difference between the debit and credit is adjusted to what is called as capital reserve or general reserve. Here in the books of transferee, whatever is the difference between net assets means what? Assets minus liabilities, and the amount of purchase consideration. The difference between net assets and the purchase consideration is treated as a reserve of the transferee company itself, right? So if the debit is short and there is capital reserve balance, adjust it otherwise against revenue reserves itself. So you can write general reserve or you can write it as capital reserve, both is correct. When purchase consideration is paid. Now, after taking over the assets and liabilities, you have calculated that some amount was due to be paid. How are you going to pay this? When it is paid, you might pay it in the form of shares, or you might pay it in the form of cash, or you might pay it in the form of some assets or whatever is being given out. Whatever you give out, whatever you pay will be credited, and who is receiving it? Who is the receiver? Liquidator of transferor company is the receiver. So the entry is liquidator of transferor company account debit to share capital, to share premium, to cash, and to non-cash items as such. Now, why did the share premium come in here? Because we might pay this old company, we might issue them shares either at par or at premium. If I issue them shares at par, that is at same value itself, so it will be written as to share capital. But in case there is a premium amount, in case there is shares being issued at a higher price, that extra amount should be written off to securities or share premium account. Similarly, if you're giving it off at a discount, you will have a debit here. So you will debit discount on issue of shares in the debit and to share capital. So if you're issuing 10 rupees worth of share at 8 rupees, you will write it as to 10 rupees itself, but discount will be written as 2 rupees in the debit itself, so that the share capital will come down to 8 rupees. And whatever is the amount of cash being paid off, that will be written as to cash. So to share capital, to cash, to assets or any other consideration which is being given to the shareholders. Why are we giving them? Because there are some shareholders who are called as dissenting shareholders. I told you there are these shareholders who 90% of them have to become shareholders of the new company. But in case of purchase, what happens? There are only 60% of them who have agreed to join. Rest 40% ka kya? So those 40% have to be paid off cash, or they have to be given off some stock, or some asset has to be paid off to them. Such shareholders who are not in favor of joining, who are not in favor of the takeover, and they will not want to continue with the new company are called as dissenting shareholders, right? So we have to pay off them the shares, their money has to be given off. Rest of them, 60% of them, we will issue them new shares of the new company, either at premium or at a discount. Is it clear here? Is it clear till here?
Yes, ma'am.
I
Yes,
want
ma'am.
everybody to go through the sums which have been done after this explanation immediately. Otherwise, you will not be able to follow. So, purchase consideration is paid off. Then, liquidation expenses might be paid by the transferor company, which we've already seen. When the transferor company pays, he's written the expenses as realization to cash. But liquidation expenses of the other company might be paid off by the new company. So the old company will say that even liquidation expenses I cannot pay, So new company should pay. So they transfer off, even they want the new company to even pay their liquidation expenses. In case liquidation expenses are paid by the old company, the transferor company, so you'll write it in the books of transferor company as realization to cash. But if this company, the transferee, is paying the realization expenses or the liquidation expenses, then it will be general reserve account debit to cash. Don't write P&L, write general reserve account debit to cash. Where will I pay money from? From my general reserve. So your expenses I am paying from my old profits. So general reserve account debit to cash for all liquidation or realization expenses paid by the transferee will be written in transferee's books. Clear? That's all. You can see you are having here a simple problem being given, that is the balance sheets of two companies, A Limited and B Limited. He says the two companies agree to amalgamate and form a new company which is called as C Limited. So here itself the first condition is correct. There's a formation of a new company which takes over all the assets and liabilities of both the companies. So again, without any exception, all the assets are taken over. So it is a merger, we know. The consideration is to be paid off at this amount and this amount for A company and B company. So we are given the purchase consideration of both the companies separately, and show the opening entries in the books of C. Also prepare the opening balance sheet in the new company, that is in the books of C Company Limited as on 1st of October. The authorized capital is just an information with which C Company has been started off. So in the new balance sheet, we will show only 2 lakhs as an information. So now C Company, first what is it doing? It will write the business purchased entry. Purchase consideration is given to you, and he says it is due amounts are there. So the total amount due will be business purchase account debtor to liquidator of A to liquidator of B with 9,76,000, both the purchase consideration put up together. Then we are taking over all the assets of A Limited and all the assets of B Limited at what values? At their book values itself. So we have to incorporate. Second entry, when we incorporate the assets and liabilities, the entry is various assets account debit to various liabilities, including the reserves, to business purchased. And the difference between the assets and liabilities, that is the net assets, minus the business purchased, will give you your general reserve itself. So how is it done? Right, so if you can see the buildings are there only in case of A Limited, 1,50,000, B doesn't have. So we will write only buildings 1,50,000. Rest for all of them, add up both their assets. Machinery of A Limited 550 plus machinery of B Limited 2,50,000 will be the new machine of C Limited will come to 8 lakhs rupees. Like this, stock of A Limited is added to stock of B Limited, debtors of A Limited, debtors of B Limited, cash balances of both the companies will become the total assets of C Limited. So this is the assets that I have taken over. Two, what are the liabilities I have taken over? You can see the liability side. A Limited is having, will not touch the capital, and for now we will take only outsiders liability. Outsiders liability, A Limited is having debentures, creditors, employment PF, employee PF, and B Limited is having only trade creditors. So the liabilities taken over will be two creditors of both of them, A and B Limited put together, two debentures of only A Limited, employee provident fund of also A Limited itself. Provision for taxation, either I can deduct it from debtors and write the net figure of debtors here, or because he's taken the gross value, he'll write provision separately. You can see here, provision was 5,000, gross debtors was 50,000. If you take 50 in assets, you will take provision 5,000. But if you take 45 in assets, you will not take provision here. Here, because he took the gross assets, he's taken the provision down as provision for bad debts. Right? Then the general reserve of both the companies put together, it is 1,50,000 plus PNL is 30,000, right? And you are having the difference between the, now you'll have to check the difference between the purchase consideration and the net assets. That will be written as the balancing figure. That will be written as the balancing figure. So if you do in your working notes, that's what I was checking. He's not done it in the working notes. The amount of purchase consideration minus the net assets of both the companies will come to 1,76,500. That is nothing but negative reserve. So deduct it from your general reserve if it's a negative figure, add it to your general reserve if it's a positive figure. And that will be nothing but your, because you have paid extra, you will write it as only the net amount after making this changes. 23,500 is what you will get to general reserve as the balancing figure. Then lastly, pay off the money to the liquidators. How are we paying
Ma'am,
the, yes?
yeah, like if it's a positive one, then will show it in debit or
We will
will
add
show
it to
in
general reserve. If it is positive, you will add.
then will show it in the paid side only.
In, yes,
But
in general reserve only, you will add it to 1,70,000 and 30. You will get it as plus amount itself because you have got a profit. Okay, we'll do for one company. You just tell me how much is the net assets. A Limited, you come here. A Limited is what? Assets. Add up all the assets minus debentures, trade creditors, and EPF. Only outsiders liabilities.
minus 7 lakh, ma'am. Just debtors, creditors, and EPF, right?
Yes.
7 lakhs.
Trade creditors, debentures, and EPS. 7 lakhs. And you have here it will be these assets 3,40,000 minus 40,000 is 3 lakhs,
2
right?
lakhs.
But how much purchase consideration you have paid is 9 lakh
95.
76,500. So how much is the difference?
23,500.
So 23,500 is to be taken in the as a general reserve.
Okay.
Why? Because you have paid extra than what, you have paid less when compared to the two net assets. The net assets that you have taken over is your 7 lakhs and your 3 lakhs. But you have paid how much? That is 10 lakhs assets you have taken over. But you have paid only 9 lakh
976.
76,500. So you have got a profit because of merger, because of takeover. You have got a profit of 23,500. So that 23,500 should be written as a general reserve itself. Suppose it is a negative figure, then you will adjust it from the general reserve which is existing only. You get that now?
Yes, ma'am.
Then lastly, pay off the purchase consideration in the form of shares. He didn't say it is at premium. So A Limited, we are giving 6,61,000. B Limited, we are giving them 3,15,000. This is the decided purchase consideration that was due. How are we paying it? We are paying it in the form of shares itself. Because nothing is mentioned to us that we gave them any other cash, etc. So therefore, it is to be paid off in the form of share capital itself. And no premium or discount, it is issued at par. Liquidation expenses, no information, so don't write the entry.
Ma'am,
Now,
one question, ma'am.
yes,
Ma'am, if in the question we are given any market value at the year end for non-current assets like building and machinery, how do we treat it under the realization account?
No, realization account you will take only book values. This is in the books of transferee. In the books of transferor, that is realization account, no revalued values. Who is revaluing? Transferee is revaluing. Transferor, there are no revalued values for him. He doesn't do any revaluation. He will simply at book balance sheet values itself, he will transfer to realization account all assets and liabilities. It is only the transferee who will go for evaluation. That too only if it is a purchase. I have not yet come to that. We are still doing merger, and in merger the condition is that assets are taken over at book values itself. There is no revaluation as such. No adjustment is intended to be made in the book values of assets and liabilities. Did you understand? This
Yes, ma'am.
is when it is in the books of transferee company. In the books of transferor, whether it's a merger or whether it's a purchase, no change. Same treatment which is closing the books of accounts. What is the transferor company doing? It is closing its balance sheet. It is transferring all its assets and liabilities to realization account, and it is receiving the purchase consideration. Whatever is the difference is being paid off to the shareholders. Purchase consideration received, paid off to the shareholders. That's all. No treatment of revaluation in the books of transferor. Whereas transferee company only there will be revaluation only if it is a purchase, not a merger. Right now we are doing only merger itself. Wherein what do? I will write capital, authorized capital first because it is given to us. He didn't write it here, but you will write authorized capital first, and you will write the share capital. What have we done? We have issued 6,61,000 and 3,15,000. So our share capital comes to 9,76,500, which is the actual purchase consideration that we paid. So we paid off this much in the form of new share capital of the new company will be 976,500. General reserve we have got is here in this entry. We've got here a general reserve of only after all adjustments. We've got only 23,500. That 23,500 under shareholders funds. Then under non-current liabilities, we've taken over debentures of A Limited 1 lakh. We've taken over creditors of both the companies. See here, creditors of both the companies you have taken over 40 plus 50 of A and B put together comes to 90,000. Employee Provident Fund only of A was there 15,000. This journal entry that you have written will form your balance sheet, right? So these are the assets, these are the liabilities that you will write, and capital is the amount of shares issued. So I've got debentures, I've got sundry creditors of both the companies, and I've got employee provident fund of B Limited, which has been written here. This becomes the liabilities of the new company, that is C Limited. Whatever assets were taken over, this debit, write all of them on the asset side. So assets of A and B put together, buildings 1,50,000, machinery of both the companies put together, stock of both the companies put together, debtors of both the companies put together, minus the provision for bad debts, and cash of both the companies put together. You will get the assets of the new company C Limited. So your problem could be just journal entries in the books of transferor company, just journal entries in the books of transferee company, only realization account in the books of transferor company, or you could have prepared the new balance sheet of the new company also. So read the problem really carefully and do it accordingly. Okay, that is when it is a merger. But if it is a purchase, you will have, as you told me, same thing, but there will be some, what do we say, revalued values. So you will take these assets, only difference is that the assets you will take over only those which have been taken over. All assets taken over with their respective values will be shown at their agreed values. So now comes your doubt. What should you do if there is a revaluation value? So only revaluation values will be written only if it is a purchase and only in the books of transferee company. Journal entries remain the same. What is going to change is the values. Here we wrote it that we didn't have any new values. So we wrote assets and liabilities at the balance sheet values itself. But now assets and liabilities will be incorporated not at the balance sheet values but at their agreed or revalued values. So at what value I'm taking over your machinery, I will record it at that value. I will not take your balance sheet value, but I will take the revalued agreed value which I have found it is correct. I will record it at that value itself because it is a takeover. And when it is a takeover, transferee will write and take over. It has all the choice and all the freedom. So it's not a new company, it's already an existing company. And it is going to take over few assets, it will not take over few assets. For example, if I have my own building and I feel that I don't need the transfer, the selling company's building is not required, or I don't need to take over your stock because I'm not going to continue your business. So I will say, I don't want your building, I will not take over your building, I will not take over your stock. In that case, what will you do? You will sell off your building and pay off your shareholders. You will sell off your stock and you will give it off to your shareholders. I will not record it in my books of accounts. Which assets will I record? Only the other assets which I have agreed to take over. So I've taken over your furniture, I've taken over your machinery, I've taken over your asset, your debtors. So those assets at their new values. So after the balance sheet, you will have the revalued values given. So at the revalued or the agreed values, I will record this entry. Assets account debit to liabilities also at the agreed values itself, and the difference is written to business purchased. Again, this debit will not be equal to the credit. There will be a difference. Remember, I told you here in this entry, there will be a difference, and whatever is the difference is written to general reserve. But here, in case of purchase, be very careful. The difference is written either to goodwill. If the difference is in the debit, you will write it as here goodwill account. But if the credit is less and you get the balancing figure in the credit, then you will write it as to capital reserve. Which means after writing this entry, assets at their agreed values, you will leave a line to business purchased at purchase consideration, which is given in the sum or you have calculated, to liabilities at agreed values. Then you will add the debit and you will add the credit. Then you will see where is the difference. If the difference is in the debit, right? So debit is less, so it is goodwill. If the credit is less, then it is capital reserve. Why? Because when will assets be less? When you are paying more. Your purchase consideration is much greater than the actual assets that you have taken over. Right? So I have taken over your assets and your liabilities, but I paid you extra than that value itself. Right? So I have paid you more than the net assets. Why have I paid you extra? It is because of goodwill, because yours is a reputed business and I have taken over your business by paying you something more, an amount greater than the actual net assets of yours. So when the transferee company pays more, when the purchase consideration is greater, extra purchase consideration is paid than the net assets, then the amount is called as goodwill. Simply what you have to do, write this entry and see where is the difference coming. If it is in the debit, write it as goodwill. If it is in the credit, write it as capital reserve. When will you get it in the credit? When your assets are greater. The value of the assets that I took over is greater than the amount of purchase consideration paid. So I took over assets worth 10 lakhs, but I paid only 8 lakhs. Why? Because the company was not doing well. So I took it over and I have earned a profit. Because I got a profit on amalgamation, I will transfer it to capital reserve. Right? So what do we have to remember when it is a purchase, when it is amalgamation in the nature of purchase, assets and liabilities will be incorporated at first agreed values only, the new values, not at balance sheet values. You will not even see the balance sheet values, you will only take the revalued values. And the difference in the net assets and the purchase consideration is transferred either to goodwill or to capital reserve as the case may be. Debit में less है तो write it as goodwill. If the difference is coming in the credit, write it as capital reserve. That's all. Journal entries don't change. What changes is only the amounts. Right now, when it is paid off, purchase consideration is discharged. Transferor company, I am paying it to the liquidator of transferor company. However, what am I paying? I can either give them share capital, I can give them preference shares, I can give them debentures, or I can give them cash. If these are at premium, write it as 2 securities premium. If these are at a discount, write it as discount on issue in the debit. Same as we've done in the merger, the same thing. Liquidator of transferor company account debit, 2 share capital, 2 debentures, 2 cash, whatever you are paying will go in the credit. These shares and debentures can be at a premium, par and discount. Whatever, however it is paid. If it is at par, then no problem, just write 2 shares, 2 debentures, that's all. But if they are at a premium or a discount, premium should be credited to securities premium, discount should be debited to discount on issue of shares or debentures. Clear? So I have written the purchase consideration entry. I have taken over the assets and liabilities and recorded, and now I have paid off the purchase consideration. Left is only if I have to pay the liquidation expenses. If the realization or liquidation or winding up expenses, they're all the same. If those expenses are paid by the new company, the transferee company, then it will debit it. I see in the earlier case I wrote it as general reserve to cash, right? In the previous case it is written off as general reserve to cash in case of merger. But if it is a purchase, you'll have to see this journal entry, the difference wala. Here if you get it as goodwill, write it as goodwill to cash. Here in the second entry, if you got it as capital reserve, write it as capital reserve to cash. Okay, so entry for realization or liquidation expenses is goodwill account debit, capital reserve account debit to cash account. When will you know what to do, which one to write? You'll have to see this incorporation entry. जो भी यहाँ पर आया, whether you got a goodwill or a capital reserve, same will be debited here. So if you got goodwill, write goodwill to cash. Earlier, if you got capital reserve, write capital reserve to cash. Clear? Followed till here. If you go through the journal entries and you see solutions, should be examples and illustrations in the book, that should be enough. This PDF also I will share. It
And
has got, yeah.
once the fourth one.
Nothing. It is those liquidation expenses of the transferor company are paid by us. So your expenses of liquidation are being paid by the purchasing company. So if acquisition or winding up or liquidation or realization, they are all the same. So if those expenses are paid by the purchasing company, I will have to write it as some account debit to cash. Which account to debit? I can either debit goodwill or capital reserve. I will debit. For that I will see the second journal entry. In the second journal entry, you understood this. The difference will come in the debit or the difference will come in the credit. If the difference is in the debit, you will write it as goodwill. Same thing you will write it here also, then goodwill to cash. But if you got here as capital reserve in the credit, difference in the credit, then here also you will write it as capital reserve to cash. Okay, and this amount will be adjusted in the new balance sheet. So if you got goodwill to cash, you have two goodwills now, one in the second entry, one in the fourth entry. So you'll write total of both of them in your balance sheet. If you got capital reserve here in the credit, and here you have a capital reserve in the debit, so you will take the net amount to the balance sheet. So either if you got capital reserve as 1000 and here you have liquidation expenses 500, so it will be 1000 minus 500, will be taken 500 only to the balance sheet. This is in the books of purchasing company in case it is amalgamation in the nature of purchase. Okay. Then if there are any statutory reserves. Now what are statutory reserves? As the name itself says, these are very important reserves which are very required by law, right? So if you are a company wherein you are following some government act, right? Some law, some act is being approved on you, applicable on you, and that law says that you have to maintain a reserve. And because of that, the transferor company is showing like this, you will be given here. Here in the balance sheet of the transferor company, you will have an amount like a statutory reserve. Right here, he says general reserve. You will have something, if you have something like a statutory reserve, then in that case, what is to be done? As it is, we will transfer statutory reserves to the transferee company by simply opening an account which is called as amalgamation adjustment account. So it will be transferred off by one journal entry. You will have to extra pass amalgamation adjustment account to statutory reserve, because statutory reserves should not be closed. They should not be paid off. They will be given off to the transferee company by opening an account which is called as amalgamation adjustment account. Then what will we do? In the balance sheet, we will write just seeing if it is there. One problem. No, it's not there. This is a very rare thing that it will be there. If it comes, then only remember and transfer it to amalgamation adjustment account and write it in the new balance sheet as it is. What you'll have to do is just go to the balance sheet and write as it is the statutory reserve. So in the new balance sheet, under reserves and surplus, you will write here after general reserve, you will write statutory reserve. And under assets, last item you will write after cash, you will write amalgamation adjustment account with the same amount, so that there is no effect on your balance sheet. That's all. As of now, don't see this, because what I have given in the examination is only realization account. Okay, so everybody write down preparation of preparation of journal entries in the books of transferor company and realization account. Just learn that much for amalgamation chapter. So for amalgamation chapter, you are going to learn only how to prepare realization account. Preparation of realization account, problems related to preparation of realization account is enough for your second internal. Okay. Fine.
Yes, ma'am.
Then you learn the theory as well, so that you should be able to answer it. This chapter I will do
Ma'am,
more
will we get
sums.
one theory and one question? One
Yes,
problem
ma, that's
in
what
the
I'm
same?
saying. For amalgamation, you can learn one theory and you can learn problem relating to preparation of realization account.
Both for 3 and 5 marks.
Sorry, both for
Both for 3
section.
and 5 marks.
Yes.
6 to 6. Thank you, ma'am.
Okay. Because as of now we can't do these sums related to this transferee company and all that. I don't want to burden. We'll do it offline in class itself after your internals. Okay, clear? So with amalgamation, what theory to be learned is this. This is the same thing. This is your realization account. With this, just prepare realization account and learn how to prepare the. I'll send the format. I'll write it and send it for you. That should be easy. One second, where did I see that? Yes. This is another important theory question. What is purchase consideration and how do we calculate it? Right, so purchase consideration is nothing but the price which is payable by the transferee company to the shareholders of the transferor company. Right, whatever amount is paid for taking over their business is called as purchase consideration. How is it calculated? These are the four methods of calculation. This is another important theory question which is given, so learn it really well. Purchase consideration can be calculated by four methods. The first one is the lump sum method. What is a lump sum method? Just now, as we saw in the sum, it was agreed that 3 lakhs and 2 lakhs something, 6 lakhs should be paid off, right? So lump sum method is wherein there is an agreed value between both the companies have agreed for a lump sum amount as purchase consideration. So both A and B have decided that purchase consideration should be 6 lakhs. Just as we saw in the sum earlier way, it is already given to us directly in the sum and it is agreed between both the companies, right? So there's no calculation as such required. Simple method, it is given in the sum. Second one is net assets method. We all know I'm taking over the assets. That is, the transferee company, purchasing company will take over the assets and the liabilities, right? So net assets we know is nothing but excess of assets over liabilities. So what is the purchase consideration I will pay you? I will pay purchase consideration as assets taken over at their revalued values, agreed values, minus liabilities taken over at agreed values. So the purchasing company, the transferring company will calculate how much should it pay. It will pay the difference between the assets taken over minus the liabilities taken over. That will be fixed as the purchase consideration. So when purchase consideration is calculated by net assets method, how is it calculated? It is nothing but the difference between the assets and liabilities taken over at agreed values. So what in the problem you could be given is calculate purchase consideration by net assets means add up all the assets at agreed values. Don't take balance sheet values. Agreed values only. And liabilities at agreed values minus both of them, difference is your purchase consideration. So the second method of calculation, this we did it in valuation of goodwill and also net assets, how to calculate. Same way. But what do we have to remember is this. We should not take fictitious assets, excluding fictitious assets, and we should not take shareholders' funds. That is reserves, P&L account, all this should not be taken. Share capital, preference share capital, equity share capital, general reserve, capital reserve, statutory reserves, all of them should not be taken. So except reserves and surplus and capital on the liability side, only outsiders liabilities should be taken. At what values? New agreed values. Coming to assets, all assets, fixed assets and current assets at new revalued values, but should not touch fictitious assets. The difference between the two is your net assets method. That is what is given here, explained as to what should be taken, what should not be taken. Liabilities, what should be taken, what should not be taken. Third method is a net payments method. It is nothing but a total or an aggregate of all the payments which are made by the purchasing company to the selling company. Total up all the payments which are made by the transferee company, which is being paid to the shareholders of the transferor company. So in the journal entry you had no, I paid cash, I paid shares, I paid debentures. So all of it is added up, whether it is paid to equity shareholders or to preference shareholders. Add up all of it, how much ever is paid, that amount should be added up and you'll get the purchase consideration. Okay, so that is the net payments method. So payment to debenture, what we have to one thing remember is any payments which I am making to debenture holders or to liabilities will not come as purchase consideration. He will purposefully give you that debenture holders were paid off so much in cash. No, they are not shareholders. What is purchase consideration? Amount paid to the shareholders. So amount paid to debenture holders? No, we will not take it in purchase consideration. You will write journal entry separately, but not in purchase consideration. So purchase consideration by net assets method is, it is a total of all the payments which is made by the transferee company to the shareholders of the transferor company. That means to the equity shareholders, whatever you paid, and to the preference shareholders, whatever you paid, not including creditors and debenture holders. If you've paid to them, it should not be included in purchase consideration. It will be dealt separately. Clear? Third method of purchase consideration. And the last method is wherein it is usually in case of merger itself, wherein we have exchanged our shares. Whatever were the shares of old transferor company, they have been taken over, and in return I have given you new shares in the new company on some basis, on some ratio basis. We have sums wherein we had seen that there were two shares. Say for example, old companies, in two shares were taken over, and in place of two shares only one share was issued. So that is nothing but shares exchange. I'm taking over, I'm cancelling your old shares, and in place of them, I'm issuing you the new shares. That is called as shares exchange method. So intrinsic or the shares exchange method is where we calculate purchase consideration on the basis of some ratio. It will be given 3 shares instead of 5 shares, or 10 shares instead of 5 shares. Some ratio will be there. So in that particular ratio, how the exchange is happening between the two companies, that is the basis for calculation of your purchase consideration. Okay. So another important question, what is purchase consideration and how do we calculate? What are the methods of calculation of purchase consideration? There are 4 methods. Explain all 4 of them for the question. Clear? Even in the sums you will
Ma'am,
have these.
ma'am, can you send this PDF?
Yes, yes, I'm going to send all of them to you. Okay. Now this is your journal entry, and what are the notes that whatever I have explained just now, it is all mentioned here. And it is attached. The other PDF as well is attached here. I've attached it. You can learn all your theory questions from here in amalgamation. That clear, everyone? So
Yes, ma'am.
amalgamation, just learn the theory questions and preparation in the transferor company itself. Preparation of realization account and simple accounting treatment in the books of transferor. Okay, when it comes to transferee, there is a problem in the sum, but don't get, because I had to put it, I have kept even that because I don't have any choice. There's a format of this. So purchasing company also I have kept those who have done it in class and those who feel that they can attempt it. Rest, everybody go for as of now amalgamation ka theory and simple sum on realization account. Okay, clear everyone? Any questions here? This is the most difficult chapter. That's why I'm going to come back to it once again after intervals. Okay, fine everybody.
Yes, ma'am.
Now coming to the most easiest one, that is internal reconstruction. Internal reconstruction, as the name
This is
itself,
unit 4, right?
yeah,
The
fourth
internal
unit.
reconstruction.
It is fourth unit, and this is wrongly written as fifth there. This is actually for the general section, not for IFA. For us, it is fourth unit itself. This was prepared for the other classes. For them, it is the fifth unit, but for us, it is the fourth unit. Internal reconstruction, fourth unit, wherein both the sums in the internal also and in the external you will have problems only. There is not much theory in this chapter. Only theory question is this: differences between internal reconstruction and external reconstruction. That also I have given in the exam. So there is only this one short answer question. I have given it. So learn this really well and attempt one theory question only. But there are problems only. What we have to do is understand just few things here. Right. When it is this company, that is a company is going in for internal reconstruction, means there is changes being made in the company's capital structure. We are making, what does internal reconstruction mean? It means we are making changes in the company's capital structure so as to have what is called as right, so as to write off any accumulated losses. Now what is happening is, even this company, our company is not doing well, our company is not doing well, we are having a lot of accumulated losses since many years. If we do not write off these losses, if we do not, you know show a clean balance sheet, then what will happen is our company might get into liquidation, might close down in future. So this is the last resort that I'm doing, that the shareholders will decide that they will reduce their share, they will sacrifice for the company and they will reduce their shares so as to reduce the accumulated losses, write off the accumulated losses and bring the assets to their fair values. Now, what we have to understand in internal reconstruction is, all assets, they show debit balance, correct? All assets show debit balance and all liabilities show, what balance? Credit balance, correct? You know this. Capital also shows credit balance itself. Now this company which is there, that is this company which is going in for internal reconstruction, what is happening is this company is having a lot of fictitious assets. That is, the assets are so high, the fictitious assets, the losses are so high that it has to reduce this. It has to reduce them. It has to write off these fictitious assets, and these fixed assets and these current assets are all at high values. You did not bring them to correct values. So what do we need to do is we need to reduce assets. How can I reduce assets? I can reduce assets only by reducing my capital, because I know capital plus your liabilities is equal to your assets. Yes. So if I have to make changes in the assets, if I have to reduce the assets, how can I reduce them? Only by reducing my capital and my liabilities. If I reduce one and I don't reduce the other, my balance sheet will not tally. It will not be correct. So as to not affect the balance sheet, what I will do is I will reduce the assets by reducing my capital. That is, first the shareholders will agree for a reduction, and I may also ask my creditors also that I will reduce your share as well. So I'm going to, what is internal reconstruction? It is reduction. It's an arrangement made by companies whereby the claims of shareholders, debenture holders, creditors, and other liabilities are all reduced, so that, why are we reducing them? Why are we reducing the liabilities and the capital? So as to reduce the accumulated losses, that is to write off the accumulated losses, and the assets at are valued at their fair value, and the balance sheet shows now this is the objective. I want to show a true and fair balance sheet of the company, right? So how do I go about with it? I will go about by it by two ways. The two methods or the two ways of reconstruction is, either I will go for reorganization of the share capital or reduction of share capital and liabilities. Reorganization is nothing but, if there are preference shares, I will say that preference shareholders are issued equity shares itself. So I've cancelled the preference shares, and in place of preference shares, I've given them new preference shares, or I've given them equity shares. So the share type has changed. The type of shares have changed. It is called as reorganization of share capital. Or I could just do is, I will reduce the capital. Equity shares are there of 10 rupees. I will say those have been reduced to 8 rupees each. That's all. So there's no change in the type of capital. Same equity to now equity only. I have not changed the type, but I've reduced the value from 10 rupees to 8 rupees shares. So either by reorganization or by reduction, internal reconstruction can be done. This is another important theory question. What are the objectives? Short answer or very short answer you can be asked. What is internal reconstruction and what is the objective of the need of it? First objective, to resolve the problem of overcapitalization or accumulated losses or overvaluation of assets. My assets are showing high values. My losses are showing high values, and that is why assets are higher. How to reduce those assets? I will reduce it by reducing my capital. Second objective of doing is, when the capital structure of the company is such complex and it is required to be made as simple. So I have equity shares, I have preference shares, I have deferred shares, I have cumulative shares, I have ordinary shares. So too complex. So I want to make it simple and give all of them as equity shares itself. So I'm reorganizing the share capital to make it as simple. Then third objective is, when the change is required in the face value of the shares. So face value of the shares from 10 rupees to 8 rupees has to be done. How can I do it? I just can't reduce it, cut it and write it there. I'll have to go in for reconstruction of the company. So the third objective is for making changes in the face value of the shares. Three objectives. Out of that, you could be asked to write like two of them, or any three of them could be asked, right? So learn the reconstruction. What is, that's only the two questions that you are asked, very short answer and short answer questions. Even in the main examination, you don't have any theory. What is this? Is nothing but internal reconstruction, is what we have just now said, wherein Company itself is going in for making changes in the capital structure. Whereas if you're involving a new company, outside third company, like how we saw it in amalgamation, it is called as external reconstruction. So when there's a merger, when there's a takeover or a purchase, it is called as external reconstruction. But if there is no other company coming, no transferee company coming into the picture, but the same company is making changes, its own shareholders and directors are internally deciding and making changes, then it is called as internal reconstruction. So you could be asked differences between internal and external reconstruction. External reconstruction is what we have studied in Unit 3, amalgamation. Internal reconstruction is what we are seeing in Unit 4, internally, without involving any transferee company. No new company comes into the picture. There is no specific terms being used. There is no reduction in capital. As it is, assets are taken over and liabilities are taken over. But here there is no such transfer that takes place in internal reconstruction. There is no company coming into it, and there is only internally changes are being made in the company's business, right? So that is nothing but your internal reconstruction. I'll just bring this up once again. Stop sharing this.